Potentia Wealth brings you the Power of Wealthness podcast.
Today, we are joined by Jack Manley, who is the Executive Director and the Global Market Strategist at JP Morgan Asset Management. Jack spends his time studying the forces shaping the financial markets and to help investors understand what economic developments may mean for their portfolios and for their financial lives. With the Federal Reserve weighing in, inflation, interest rates, tariffs, economic growth, and the rapidly expanding influence of artificial intelligence, we certainly have a great deal to discuss today. Jack, welcome to the Power of Wealthness.
Thanks, Kevin. It's good to be here.
Yeah, let's jump in. The Fed just met. And what was the message behind the headlines?
Well, sort of surprising and not surprising at the same time. I would say there was a lot of uncertainty going into this most recent meeting about whether or not the Fed was going to hike interest rates in the face of warmer inflation. My view had always been that the Fed was going to hold steady at this past meeting. I was sort of vindicated, which is nice. The Fed did indeed hold steady. There was no change in interest rates. So I guess depending on with whom you're speaking, that was a surprise or not so much a surprise. The other thing that I think was interesting, though, is how dramatically the new chair, Kevin Warsh, and this is going to be his second meeting as chairman of the Federal Reserve, how dramatically he adjusted, I'd say, the methods of communication for the Federal Reserve, like the typical kind of press conference statements. These things are usually pretty verbose. They give the market a lot to chew on, and those press conferences in particular give the press a lot of opportunities to ask a lot of different questions. And generally speaking, get pretty candid, maybe not off the cuff, but at least, well thought of responses from the people that are making policy. Warsh really reined that in, and I think sent a very clear signal to markets that he is planning on running the institution of the Federal Reserve itself in a different manner than his predecessor, Jay Powell. And that I think was very interesting too.
Yeah, well, for Powell, it was a change because he specifically shifted more towards communication and being more transparent.
Yeah.
And I think that Walsh had already said that he was going to be, well, let's say not less transparent, but a lot less communication moving forward. So what economic information will the Fed be watching for the next meeting?
So I think this has a lot to do with again, how Warsh is kind of changing up the Fed and how he thinks about managing the institution and monetary policy. We know that really since the financial crisis, the Fed has they've maintained a dual mandate with Congress. They are looking for both maximum employment, which is basically a measure of the unemployment rate, and they're looking for price stability or stability in prices, which is effectively a target for inflation. And that target has historically, and when I say historically, I mean, again, really since the financial crisis, been right around 2%. So at a very high level, Kevin, that's what they're going to be paying attention to, right? They're going to be paying attention to the jobs reports that are coming out with particular emphasis on what's happening with the unemployment rate. Although given some of the dynamics on the supply side of labor, namely bad demographics and a pretty aggressively changed immigration policy, I suppose, they're going to be paying a lot of attention to payroll gains as well. And they'll be paying attention to inflation. But that inflation side of things, I think, is where the conversation gets a lot more nuanced, because there are a lot of different ways to measure inflation. And the Fed has one sort of view that it has historically taken. There's one metric that it likes to pay attention to. But Warsh, as part of his mandate, is sort of exploring if that's the right measure or not. So when I think about inflation, the numbers that we see when you're flipping through the Wall Street Journal or you get a push notification on your phone or whatever, those are typically going to be CPI inflation or consumer price index inflation. The Federal Reserve actually doesn't pay attention to CPI. The Fed targets an alternate measure of inflation called PCE, or the Personal Consumption Expenditure Deflator for Inflation, PCE. And there are a couple of differences between PCE and CPI that make PCE, at least to the Federal Reserve, a more appealing way to look at inflation. And I would say the most important one is that whereas CPI is rebalanced on an annual basis. In other words, like there's a basket of goods and services that we all buy collectively as a country. And we spend 2% of our budget on eggs and 10% of our budget on apparel and 8% of our budget on gasoline or whatever it happens to be. And those are the weights for the basket from which the CPI index is constructed. PCE inflation actually rebalances much more frequently. It's going to rebalance on a monthly basis, which allows for a little bit more fluidity, a little bit more flexibility in how we think about inflation. It also, and this is, I think, an important point, it allows for the substitution of goods or services if a comparable product or service ends up, increasing in cost. And the sort of clean example of this would be, let's say you buy one particular type of detergent, right, for doing your laundry, and somewhere in that company's kind of pipeline of logistics, something bad happens, and the cost of your detergent, whatever your detergent happens to be, the cost of that detergent doubles, and all of a sudden now you're paying twice as much for that detergent that you had paid before. Unless you are like a die-hard evangelist for that one particular brand of detergent, there's a pretty good chance you're just going to shift to another brand of detergent. Because at the end of the day, you still got to wash your clothes. You don't really care too much about what's in there. Yeah, you prefer brand A, but brand B is more or less the same thing. I'm going to substitute that one good for another. And as a result, I, as an end consumer, don't experience that inflation that's showing up in brand A and in detergent brand A. That kind of flexibility, that substitution of goods is what flows through into PCE and makes, again, PCE a little bit more, I would say, of an appealing inflation measure for the Fed in general. But even from there, Kevin, there are so many different things that you can do when you're looking at inflation. Do you pay attention to headline prices, which is basically everything, and that's what the Fed does right now? Or do you strip out the more volatile components like what you get out of energy costs or food costs and focus in on something that's called core? Do you remove shelter from the equation? Because shelter is like the biggest part of inflation, and in many cases is not necessarily subject to interest rate policy, at least the way that shelter is constructed right now. Do you trim out outliers where, if airfare is up 40% in 1 month, but then goes right back to doing what it had been doing, and every month after that, do you make a policy decision based off of that one kind of blip on the radar, or do you eliminate those outliers and focus just in on what sort of the trend is underneath the surface? Do you focus on median? Do you focus on average? There are a lot of different ways to think about the inflation side of the mandate. And while the Fed does it one way, that's not like the rule. There are a lot of other central banks that do things differently. And so, kind of a roundabout way to get back to that initial question, Kevin, what's the Fed paying attention to? Well, they're paying attention to the jobs and they're paying attention to inflation. But which measures they pay attention to, that I think is a big area for debate through the end of the year.
Yeah. I think for individuals, they're not so concerned about what index the Fed is looking to. They're concerned about what's hitting them, what's impacting them on a daily basis. And even though inflation is down significantly from its peak, investors still feel like life is more expensive. And why is that?
Well, it's because life is more expensive. It's because everything costs more money, more or less, than it did, 5 or 6 years ago. That is the unfortunate reality. Inflation is insidious. Now, for what it's worth, it's just like a quick little aside. You don't actually want to root for deflation, because deflation is its own problem. It leads to its own sort of set of dislocations and issues with the economy. So 2-3% inflation is actually just fine, and that's more or less where we are right now. But when I think about inflation from a consumer perspective, right, from the end user perspective, from me or you or our loved ones, our family, our friends, your clients, whatever it is, we're all going to experience, to your point, inflation in different ways, because we all have our own individual baskets of goods and services that maybe we either weight a little bit differently than the official average CPI weighting or PCE weighting, or there might be certain components of inflation that don't even capture what we spend or capture things that we don't spend money on. So I even think about it at a personal level. I live in New York City. I know how to drive a car. I'm not a city kid. I have a license. I know how to drive a car, but I don't own a car. And so I don't have to worry about auto insurance. I don't have to worry about, the cost of repairing a vehicle if it gets in a fender bender, or, the cost of a new vehicle as it rolls off the lot, or the cost of a replacement vehicle, or, a used car or whatever. Like, I don't care about that at all. It doesn't make a lick of a difference to me. And yet auto insurance and other components related to the auto value chain are going to be part of inflation. Now, another way to think about this is, believe it or not, I think this surprises a lot of people. The costs associated with home ownership are actually not incorporated into inflation. And that's like really shocking, right? Because shelter is a big portion of inflation. And so you'd think that shelter means home ownership. It in fact is not. The way that the Bureau of Labor Statistics, and they're the organization that puts together the CPI basket, the way the Bureau of Labor Statistics looks at inflation, they pay attention to something that's much more close to the rental market. It's looking at either actual like realized rents, so what you're paying to rent a place. It's looking at what's referred to as owner's equivalent rent, which is saying like, hey, Kevin, maybe you own your house. What would you rent it for if you had to rent it out? And then, how do you come up with that number? Like kind of finger to the wind, like, I don't know, this is how much I think it's worth based off of comparisons in my area, based off of what's going on with the local rental market. And it also incorporates renters insurance. And I think that's one of the big sticking points here for explaining how inflation as like a concept that the Federal Reserve pays attention to does not always line up with inflation as like you, the end user, the end consumer actually end up experiencing. Because in a lot of states across the country, California is an example of this, Florida is an example of this, there are certain parts of those states that have effectively become uninsurable. Like insurers have essentially pulled out because you have an elevated risk of natural disaster, whether it's flooding or fires or whatever it happens to be. And I speak to so many investors that have had their homeowners insurance policies, increase by 20, 30, 40% per year. That doesn't flow through into inflation. Meanwhile, I live in New York City. I'm a renter. My rent inflation or my renter's insurance inflation has been like 2% a year, 3% a year. So whenever I have these conversations about inflation with our clients, with investors, I always like to remind them like, look, the Fed, for better or for worse, doesn't care about you, the individual. Right? They're not paying attention to you and your basket of goods and your basket of services and the way that you spend money. They are paying attention to things in aggregate at a national level. It's the only way that they can hope to even have a view on what's going on with prices very broadly in the United States. And so it's important to draw that distinction, right? That like what the Fed's paying attention to, what you get cited in the news is not necessarily what you're experiencing, but that doesn't make a difference when it comes to the actual changes in policy that may occur.
Like the conflict that we've got in the Strait of Hormuz right now, how much is that affecting inflation? And is that, I know this word is used a lot, too much, but transitory?
A dirty word on the podcast. I don't know. Transitory. Ooh, you got to censor that one. So it is and it isn't. It's really interesting. I mean, there is plenty of evidence that the conflict in Iran, the effective closure of the Strait of Hormuz, the greatest energy supply shock the world has ever seen. And that is presently what we are living through. There has never been an energy shock as great as the one that we're living through right now. There is plenty of evidence that that's flowing through into inflation, right? In February, I want to make sure I got my numbers right here. In February of this year, so the last full month before the conflict kicked off, headline inflation in the United States was 2.3%. Not bad. In March, it was 3.3%. In April, it was 3.8%. In May, it was 4.2%. That is almost 200 basis points, almost 2 full percentage points of upward pressure on prices in 3 months, due entirely to this shock in the Middle East, to this incredible energy crunch that we're living through right now. That said, all of that extra inflation that we've experienced right now is just coming from energy costs. Those higher energy costs, whether it is, gasoline costs or natural gas costs or fuel oil or whatever it is, electricity costs, none of that inflation has spilled over into other components of the sort of broader inflationary complex. And so if this conflict were to wrap up tomorrow and the cost of a barrel of oil were to fall back to where it was in the days and weeks leading up to the bombs starting to drop, you would see inflation drop right back down to 2.3% in about a month. So, is it having an impact? Is it not? It depends how you're looking at it. Because if you're looking at it in aggregate, yes, of course, tons of upward pressure on prices. We have lots of evidence of that. But if you're opening up the hood and looking at it a little bit more critically, this problem is very, very concentrated to one particular pocket of inflation. I think that's an important consideration as, again, we think about what the Fed might be doing through the end of the year.
If this conflict doesn't wrap up fairly quickly, though, you will see that spillover because those natural resources, they flow into everything. I mean, everything's transported. It's going to even affect you if you're not driving.
Yes, even I will feel the impact of higher gasoline prices because my Uber will end up being a little bit more money. You're absolutely right, Kevin. But this might be an overly simplistic way to think about things, but this is how I think about it anyway. The risk of residual inflation, of kind of carryover inflation, is real. And if this conflict drags on in perpetuity and the cost of a barrel of oil stays, between $80 and $100 a barrel for the next 6 to 12 months, you are going to see more residual inflation. I would say, though, that the risk of that residual inflation, like fundamentally transforming the inflationary outlook, is actually still pretty diminished. And this comes back to something that I was just talking about earlier when we were chatting about shelter costs, right? And how shelter costs in inflation are actually much more a reflection of the rental market than they are of the home ownership market. When you strip out energy from the most recent inflation reads, about 50% of the inflation that we're getting right now is coming from shelter costs. Now, higher energy costs, I suppose, can flow through into higher shelter costs, but it takes a lot of steps to kind of get there. And bear with me here as I kind of run through this. Is going to sound pedantic, but I think it's an interesting thought exercise. Like, okay, higher energy costs translate into warmer inflation, or at the very least, warmer inflation expectations. And that increase in inflation expectations translates into a move higher in interest rates because the market thinks the Fed is now going to have to hike in response to warmer inflation. And that move higher in interest rates translates into 30-year fixed rate mortgage rates increasing. And the increase in mortgage rates translates into a decrease in home ownership affordability. And that decrease in affordability translates into an increased appetite for renters. And that increased appetite for renters translates into landlords having a little bit more pricing power than they would have otherwise and raising the rent on their tenants by more than what would have been organically possible. Okay, like there you go. I got you from higher oil prices to higher rent costs, but that was like 6 or 7 things that I had to jump through before I got to that point. I think the risk of spillover in shelter, and shelter is 50% of inflation ex energy, is minimal. And that's just one example, Kevin. Like, we don't have to go through all these things, but like, that's just one example of how, even when you look underneath the hood, like, yes, there is room for residual inflation, undoubtedly. But we're not talking about an extra 200 basis points, 300 basis points, 400 basis points from higher energy costs. We are talking about a fraction of that increase. And so the risk there, I think, is actually still reasonably contained.
Yeah. Thank you for that. We've seen a lot more tariffs playing an increasing role in our economic policy. Who pays tariffs?
Man, I almost forgot about tariffs, Kevin. It's something that's like been shifted so far to the back burner for most investors nowadays. I mean, frankly, there are a lot of other things to be paying attention to that I haven't thought a lot about tariffs. But you're right? Because like just recently, there were a series of headlines about new tariffs being laid on a number of different trading partners, at least partially in response to the Supreme Court striking down those IEEPA tariffs earlier this year. And so tariffs, for those of us that care, are kind of right back front and center. And there's sort of a thread throughout everything that we've been talking about today, which is like the classic put down of your typical economist, where they speak with both hands because it's like on the one hand this, on the other hand this, right? There's never like a straightforward answer. There's never a clear like this is what's going to happen. It's much more, well, this could happen or this could happen. When I think about who pays tariffs, it depends, right? It could be the importer, or it certainly is the importer. The importer is going to be paying tariffs on the goods that are coming through. But does the importer decide to pass on those higher costs to their consumers? In which case, ultimately, the tariffs are paid by the end consumers of these goods? Or does the importer decide, hey, we're going to eat this higher cost to protect our market share or whatever it happens to be, and just put a little bit of downward pressure on our margins? We'll become a little bit less profitable. There's a scenario there where consumers don't actually end up feeling the bulk of the price increase. So kind of different ways to think about it. But I think you're seeing kind of both of those things play out in parallel when we think about the current tariff regime.
Yeah. And so as we continue to see tariffs popping up again, there are benefits from tariffs, or at least intended benefits. What are those?
So there are a couple of reasons why tariffs are, at least on paper, or I guess a few reasons why tariffs are, at least on paper, a positive. One of those reasons would be that they are used as kind of a cudgel to push foreign tariffs on American goods lower. And one of the things that I think is perhaps not discussed as much as it should be is that going into this latest round of the trade war, because remember, this trade war initially kicked off during the first Trump administration. It's been escalated during the second one, but it's been around since the first one. There was a lack of parity between the United States and many of its trading partners when it came to average effective tariffs. European countries, as an example, have a very high tariff on American automobile imports, far higher than anything that Americans were levying on European imports. There are plenty of European cars on our roads here. Part of the goal of tariffs is to get those foreign countries to reduce their tariffs. And then in theory, we reduce our tariffs. And now, hey, all of a sudden, you are actually left with a world where there's greater trade and greater flow than there had been before these tariffs had been put in place. That's one reason, right? At least academically, why you can talk about tariffs. Another reason to talk about tariffs, and this is a little bit more of a practical reason to talk about tariffs, is that the United States is in a really messy situation from a fiscal perspective. We have been borrowing to spend for the past 20 years at least. We are projected to run close to a $2 trillion deficit in 2026. The result of that is that our debt load continues to grow and that the cost of servicing that debt continues to be a bigger and bigger portion of federal government expenditures. Like the government is spending more and more money paying down treasury bills, which means less money to spend on everything else, which is typically where you'd want that money going to. And so tariffs have actually become a fairly significant source of federal revenues. And the amount of federal revenues that are derived from tariffs today are 4x what they were 2 years ago, and about as high as they've been in like 70 or 80 years. So that's another reason why on paper tariffs might be a popular policy goal. Another reason I would say, we can list a bunch of these, but I guess the last one that I'll mention here is that tariffs in theory are meant to protect American industries. America as an industrial powerhouse has been in decline for a very long time. We are no longer a manufacturing-driven economy. We are much more of a services and technology-driven economy, and it's made us very rich, but it has also resulted out in a hollowing out of the middle class, right? Those sort of typical factory jobs that you would have thought about 60, 70, 80 years ago have all basically gone over to China. And it has resulted in what could be perceived as a real threat to national security, because if you're not building the aircraft carrier, if you're not building the cargo ships here, and you're not building the airplanes here, and you're not building the automobiles here, we are now beholden to foreign countries who can all of a sudden just say to us all right, no more cargo ships for you, or no more airplanes for you, or, no more cars for you. And then what do you do, right? So there is also this kind of almost economic nationalism associated with tariffs, where this on paper helps to shore up, our own sort of collective national defense ethos, whatever you want to call it. It also, on paper, encourages the sort of rebirth, the renaissance of America's industrial base, its manufacturing base that has been sort of whittled away over the past 30 or 40 years. And, how effective any of these things actually are in practice, there's a lot of room for debate on that. And we'll be talking about this, I'm sure, for decades to come.
Yes.
For decades, exactly. But at least for right now, those are a few, I think, like kind of academic arguments in favor of tariffs.
Let's shift over to artificial intelligence. We've been pumping a lot of money into AI in this economy. Are we seeing economic growth from that?
Oh, now that is a loaded question, Kevin, because again, putting my economist hat on, like yes and no. Yes, because all that money that's getting spent, and the latest figures I've seen for this year are projecting around $700 billion in artificial intelligence related CapEx. Last year was around $500 billion. Next year is projected to clear $1 trillion. I mean, these are unfathomable numbers. They are numbers that are bigger than the GDPs of most countries. The overwhelming majority of that money is flowing right back into the U.S. economy. It's U.S. companies that are spending all this money and sending it to other U.S. companies to help to build out the artificial intelligence kind of infrastructure, right? To build out the framework. And so AI as a theme has been enormously impactful on economic growth over the past 18 months. And in fact, business investment, and most of that business investment is actually going to be AI CapEx, business investment was the single largest driver of economic growth in the first half of last year. It was the single largest driver of economic growth in the first quarter of this year. And it was the second largest driver of economic growth in the second quarter of this year. We just got those numbers just this past week. Like without AI CapEx, this economy would be in a completely different position. So yes, on the one hand, AI is having a huge impact on the economy because of all the spend that's going into it. On the other hand, though, when people typically ask that question, Kevin, I feel like the sort of the subcurrent like notion behind it is AI leading to like productivity gains? Like, is AI making us better at our job? Is it making us more efficient? Is it allowing us to increase our output without any more additional work? And that's, I think, where the jury is still very much out. A lot of people use artificial intelligence. In fact, when you think about sort of past like technological cycles, there are more people using AI day to day at this stage in like its rollout than there were people using the internet day to day at this stage in its rollout. Like the progression to mass adoption is so much faster than it was even 20 or 30 years ago. Everybody's got like ChatGPT or Claude or Gemini or whatever on their phone, on their computer. So there's a lot of adoption, and adoption typically translates into productivity gains. But it's not so clear where those gains are just yet. I mean, AI certainly can make us more productive. It could also make us much lazier. The increased productivity, just because you're making more stuff doesn't mean the stuff that you're making is any better. That's become a big problem, right? Is this idea of like AI slop. And I'm sure, so many of us have seen this on social media or in traditional media or whatever. Like, people have turned their brains off completely and they just let artificial intelligence, spew out nonsense. And it's a much more prickly conversation. And so the idea, right, the hope is that at some point, all this spend pays off in an explosion in productivity. And we go through the same sort of transformation that we saw when the steam engine was invented, or when the internal combustion engine was invented, or the personal computer, or the internet, or the smartphone. And like, AI is just another one of these kind of general purpose technologies that everybody uses. It's folded into every aspect of our lives. It does make us better. It makes us smarter. It makes us faster. But the data are not there to support it just yet. So yes, it's having an impact, but not the kind that we're looking for longer term. And so I think we're kind of at this interesting juncture almost when it comes to like, show me the money. Like, all right, you poured all this stuff in, you built out all the systems, everybody's got this stuff on their phone. now what? And I think that's the big question.
Good. We've talked about the Fed and the conversations we've had. We're now heading into midterm elections. Do you see that having much impact on the market?
Well, I would say in general that midterms always lead to volatility. Markets are always more choppy around midterms. So that's something that we should probably expect. We also know that there have been a lot of like congressional or like Congress related headlines recently that could make these midterms a little bit spicier, right? There have been a number of pretty high profiling redistricting efforts on both sides of the aisle that could result in some sort of unexpected changes to the composition of government. There have been some high profile, either resignations or individuals that have announced that they're not planning on running again. We just had a U.S. senator pass away not too long ago. A lot of big changes on that front. And so while the base case is that it will be bumpy, like midterms are always bumpy, this could be bumpier still, right? And you might remember it was back in 2020. There were those 2 runoff elections in the state of Georgia, and nobody expected Georgia to go blue. And so nobody expected the Democrats to sweep. And yet Georgia went blue in those runoffs. The Democrats did sweep. And all of a sudden, what should have wrapped up halfway through November was now dragged into basically February when we dealt with it could get worse from like a noise perspective, from a volatility perspective, but assume just kind of baseline midterms inject volatility because they inject uncertainty. But longer term, Kevin, I would say there are like 2 big things to remember about politics in general, and this is applicable to midterms in particular. Politics and the composition of government from a political perspective has historically speaking had essentially no bearing whatsoever on the performance of the economy or the performance of the stock market. And I think a lot of people would be surprised to know that the annualized S&P 500 returns under the Obama administration were almost identical to the annualized returns under the Trump administration, which were almost identical to the annualized returns under the Biden administration. And you can say the same thing about economic growth, more or less the same, whether you're looking at Obama or Trump 1 or Biden or Trump 2. The economy has historically averaged between 2 and 2.5%. The equity market has incredibly averaged around 16% annualized over that time period. And I think if you look at the numbers, having a Democrat in the White House is typically a little bit better for the economy. Having a Republican in the White House is typically a little bit better for the stock market. Maybe that lines up with your policy views. Maybe it doesn't. But either way, things are growing and you're making money. So like right off the bat, right, from a markets perspective, forget about your own personal beliefs, but from like an investing perspective, don't worry about what happens in November. It is not going to make a lick of a difference for your long-term portfolio returns.
Yep. I hear you say short term, we may have some volatility. Long term is just the outcome, regardless of what the outcome is not going to have an impact.
Exactly. It comes out in the wash. And we are extraordinarily fortunate as Americans where our economy and our capital markets are not particularly sensitive to who's in charge. Like that's very different than a lot of other countries, certainly in emerging markets, but even in many developed markets. Like the guy that's in charge can make or break the whole thing. And that's not the way it really works here, which I think is very lucky. We don't have to worry about this as much as many others around the world might. The other thing to point out here, Kevin, and this might be a little bit contentious, although I don't think it should be, like, when you think about everything that Trump 2.0 has been known for, and there's a lot of stuff, right? Like aggressive changes to immigration policy, aggressive changes to the regulatory environment, whether that's for financial services, for energy, for healthcare, obviously the conflict in the Middle East, the war, the tariff regime. We talked about that earlier. None of that had anything to do with Congress. Like none of it. Like this is a president that has been remarkably effective at sort of testing the boundaries of executive authority. And when it comes to trade policy or foreign policy more broadly, or immigration policy or the regulatory regime, Congress has ceded a lot of that authority over the past 50, 60 years to the executive branch and to regulatory bodies. And so, like, you may see a changing of the guard in Washington. You may see the Republicans lose one, if not both, chambers of Congress. But unless the Democrats are able to drum up some sort of super majority that would allow them to beat a presidential veto or like a filibuster in the Senate, it's not really going to change how things are run. The one exception being, maybe it means impeachment proceedings begin like they did during the first Trump administration. And there's another example of a lot more volatility because of a lot more uncertainty. So, like, keep your eye on the ball, right? Like, pay attention to what's going on. Whatever ends up happening in November is going to be very interesting. But from a day-to-day policy perspective, and kind of by extension from a day-to-day markets perspective, not a lot, I think, is going to change.
We've covered a lot of big topics here. What, in your opinion, would be the risk that investors may underestimate in the next year?
I would say I am, generally speaking, Kevin, like a glass half full kind of guy. So I'm always going to be more optimistic than pessimistic. I think, first of all, you have to be. It's a good way to live. It's also like, it's very much supported by history. Like, you never want to bet against the U.S. equity market. You never want to bet against the economy. So I say all that, right, to kind of set the stage and say, look, I am an optimist and I feel good about where we're going. I'm constructive on risk assets. I think the economy's fine. I think the stock market's fine. There are some risks out there, and there are some big kind of meaty tail risks that are like not even really worth talking about. You know, like China invades Taiwan. That's a huge problem for a lot of different reasons, but it's probably not going to happen. So we don't really have to like spend too much time thinking about that because it's such a big, like, long tail risk that it's not worth spinning the gears. Something a little bit more close to home, though, and this kind of relates to something that you and I were speaking about earlier, is all of this money that's getting pumped into artificial intelligence. Like, the equity market has been driven almost singularly by AI as a theme. The economy, as we mentioned earlier, has been driven almost singularly by AI as a theme. And while no one can argue that this stuff isn't cool or impressive or even like borderline science fiction-y, the economics of it are still a black box. Like, nobody really understands how these companies are going to be able to generate sufficient revenues, forget about profits, but sufficient revenues to justify several $1 trillion worth of capex. It is still a huge question mark. And if at any point, one player in this game decides, like, I'm going to go sit out, right? I'm going to the bench. I'm waiting things out. There is the very real risk of like a domino effect where the other players start to say, okay, maybe I don't have to spend so much. Well, if he's not spending as much, then maybe I don't have to spend so much. And then the whole thing deflates, and it deflates very quickly. So it's not my base case because, again, I'm an optimist and there are smart people out there trying to figure out how to make money on this stuff. And I have no doubt that they will. Maybe we won't be happy because now we're paying $400 a month for our ChatGPT subscriptions, but like, they're going to figure out how to monetize this stuff and they'll do it sooner rather than later. But that, I think, is a risk that's easy to ignore when you consider that, everybody's using this stuff, everybody's got a subscription, and so surely it must be economically viable. That's not necessarily true.
Right. Well, given all this, what guidance would you have for the long-term investors out there who are trying to make money on this?
Well, you said it right there yourself, Kevin, which is you got to be long-term because most of this noise kind of comes out, it's mixing metaphors here, but most of this noise kind of comes out in the wash. I promise you that what we are worried about right now is not what we're going to be worried about 5 years from now. And what we were worrying about 5 years ago is not what we're worrying about right now. Like, there's always something new to be concerned about, but whatever's going on at the moment will pass. It always does. And so having that long-term view, I think, is very helpful. Being diversified is very helpful, which means, yes, stocks and bonds, but it also means even within those asset classes, looking beyond just large cap US tech companies, for example, hedging your bets against this like deep AI concentration. It also means not being afraid of volatility because volatility is always a normal part of market cycles. There's always going to be choppiness. And as we just talked about with the midterms, it's probably going to get worse before it gets better. You have to be able to like kind of hold on and grit your teeth and just deal with it because you'll come out on the other side and you'll be completely fine. And then finally, Kevin, it means like, don't try to time this market. Like there have been a lot of headlines this year. There will be a lot more headlines before the year is up. If you had invested based off of those headlines, you'd be in a mess right now. So as long as you stay the course, like I deleted all my social media. I can't tell you how liberating that is to like not have any of this crap on my phone. I am totally like blind to so much of what's going on out there. And it's great because 2 days later, it doesn't matter anymore. And I would have gotten myself all worked up about it for absolutely nothing. And I see my friends do that. My wife does that. I love not being on social media. So a little bit of personal advice there too, maybe unsolicited, but a little bit of personal advice there too. But I think that combination of factors has worked out very, very well and will continue to be probably the best course of action looking forward.
And you talk about 5 years from now, we'll not be looking at the same thing. And I'd say that even with our portfolios, we're not looking at the same thing this year that we were last year.
Yeah.
So, Jack, I just want to say thank you for helping us better understand how the Federal Reserve, inflation, tariffs, and artificial intelligence are shaping the economy and the financial markets. To our listeners, remember that the headlines may influence us in the short term, but thoughtful planning and thoughtful decision-making are essential for financial confidence. Please remember to like, subscribe, and share this conversation with someone who may benefit from it. And as always, remember to be proactive, be prepared, and look out for one another. Until next time, be the power of wealthness.
Thank you for listening to the Power of Wealthness podcast. Click the follow button to be notified when new episodes become available. Visit our website at potentiawealth.com or give us a call at 408-288-7886. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Potentia Wealth or Potentia RIA. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Investment advice offered through Potentia RIA LLC, a registered investment advisor.